Hello, we're talking about itemized deductions. There are several different types of itemized deductions, and we're just going to go over the overview in this discussion. So, there are medical deductions for diagnosis, cure, treatment for functions of the body. So if you meet this definition, odds are that there'll be a deduction. Transportation, essential transportation for medical appointments. Qualified long-term care service, insurance, and either medical insurance or long-term care insurance, as well as prescribed medicine. Now, one thing to point out, and I don't have another slide on this, is to get these deductions, the deductions themselves have to be rather high. They have to exceed 10% of adjusted gross income, and that's why a lot of people don't qualify for these, even though they have them. State and local taxes are often itemized deductions. So one type of state and local taxes are personal property taxes. These could be on vehicles, they could be on any number of things. Local real estate taxes are also deductible. Other state and local taxes. And for foreign taxes, there can be a credit or a Schedule A deduction, but not both. Let me point out that generally speaking, these taxes cannot be fees, which means they cannot be a set amount. They have to be based on the value of the vehicle, based on income, something like that. Deductible interest. Mortgage interest and home equity loan interest are deductible. Points, in some cases. Points usually are associated with taking out a new mortgage, and very often they're not all deductible in the year that you pay them. Sometimes you have to deduct them over the term of the mortgage. Mortgage insurance premiums are deductible. And investment interest. Although investment interest is limited to offsetting investment income. Charitable interest deductions. You've no doubt heard about charitable deductions, and to get one, the organization that you've donated to has to meet one of these 5 criteria. Either a governmental unit for a public purpose, a nonprofit organization for religious, charitable, scientific, literary, or educational purposes, a post or another organization of veterans. No part of the benefits could be for a private individual here. Could be a fraternal organization that is religious, charitable, scientific, or educational. I want to point out here that notice these criteria. So something like a Kiwanis Club or a Rotary Club, to the extent that there's dues that cover lunches and socializing, those are not deductible. But to the extent that those organizations do charitable work, then the charitable portion is deductible. And also, many families have cemeteries. So what we're getting at here in number 5 is if we have a family cemetery or a community cemetery where the owners are the ones who benefit, then this is deductible. With regard to large charitable contributions, if contributions are less than $250, normally a simple receipt from the organization or even a canceled check is fine. If it's $250 or over, then the organization has to give a written note that meets certain criteria. The note must say what the date of the charitable contribution was, the amount of the charitable contribution. It needs to talk about the good or service that the charitable organization received from you. And also, it must be a good estimate of the value. And if it's over a $500 charitable contribution, then a Form 8283 needs to be filled out. Casualty losses. Obviously, like a lot of things in this chapter, you can do reading and get a lot more, but many types of casualty losses are deductible, and here's just a basic overview. Normally, the casualty loss has to be an identifiable event, and it's a sudden, unexpected event, and it's identifiable in nature. Each separate casualty needs to be reduced by $100, so that means that the first 100 is not deductible. And then the casualty losses must exceed 10% of adjusted gross income. So like medical expenses, a fair amount of casualty losses won't meet the threshold and therefore won't be deductible. Miscellaneous deductions. These are only deductible to the extent they exceed 2% of adjusted gross income, and they would include unreimbursed employee business expenses, union or professional dues, and subscriptions. And these are implying subscriptions of these organizations. Expense on investment income, investment counsel and advisory fees for investment products, tax preparation, the cost of a safe deposit box, and gambling losses to the extent of gambling winnings. Many itemized deductions are limited, and so they're limited to the lesser of 3% of the excess of adjusted gross income over the limit, or 80% of the itemized deduction. So the lesser of 3% of the excess of AGI over the limit, or 80% of the itemized deductions. The limitation then is for high income individuals, and you see here at the bottom, married filing joint, adjusted gross income if they file a joint tax return, $309,900 is the amount where if a couple makes more than that, then they start to have limitations on their deductions. If you have a married filing separately individual, then adjusted gross income, as that gets above $154,950, then there's a limitation of the itemized deductions. Now, one last note I want to make, and there are no more slides, is that usually when taxpayers are trying to decide whether to take the standard deduction or the itemized deduction, this is an either-or thing. So either you fill out Schedule A and you take the itemized deductions, or you do a standard deduction. Whichever one you choose, it's based on which one's higher. So if the itemized deductions are higher, you choose those. If the standard deductions are higher, you choose those. Take care, and good luck.